We're excited.
Well, good. Well, let's get started. Welcome, everybody. We're really glad to have you here. I'm Amy Moody, and I am an associate advisor here at Flagstone Financial Management, joined by Dan Staus, who is a lead advisor here. And today we're going to be discussing withdrawal strategies in retirement, and we'll also take any financial related questions that you might have. You can go ahead and enter them in the Q&A button at the bottom of your screen. Flagstone Financial Management is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance. All right, Dan, are you ready to get started?
Yeah, and just to reiterate, for those of you who have never joined us for an office hours, it's really a time for us to connect with you on a regular basis without, if you're not a client, you can connect with us this way. If you are a client, we can interact with you a little bit outside of our normal scheduled meetings. So we really hope that you feel free to come attend office hours, type into the chat whatever questions you have. Doesn't have to be related to the topic that I'm going to present today. It can be anything. So it's more fun for me to answer questions from attendees than it is to just blat at you about whatever topic I've prepared. So please throw some questions in the chat if you have anything that's on your mind. With that said, the topic that I'm going to talk about for maybe 15 minutes or so before we get into Q&A is retirement withdrawal strategies. So a lot of our clients are about to retire, or they've recently retired, or maybe they've been retired for 20 years. But where you take money from and how much you take from various places is a big question that's on a lot of retirees' mind. So hopefully, if you do your own financial planning, if you're total DIYer, then hopefully you get some tips today. If we're helping you with financial planning and investment management, then this will give you a kind of a peek at what some of the things we think about. And you're welcome to reach out to us afterwards if you have any questions on how these things relate to your specific situation. So I am going to share my screen and show you some stuff that I prepared with about how to think about withdrawal strategies. So there's a couple things that you need to do before you even form a withdrawal strategy. It's necessary because these things affect what decisions you make with a withdrawal strategy. So number one, form a Social Security claiming strategy. You can claim anywhere between 62 and 70, depending on some various things. And whether it makes sense to claim early or claim late depends on a lot of things. That's actually what last month's office hours was about. So you can hop on YouTube and watch that if you feel inclined. Or you can just, if you're a client, we probably either have or are going to talk to you about retirement claim or a Social Security claiming strategy. So that's number one, figure out when you're going to take Social Security. And number two, figure out how much you can afford to spend each year without being in danger of running out of money. That's a really complicated thing to do. If you're using us, then we go through the whole planning process to figure out how much you can spend each year. If you're not using us, you can use some distribution rules of thumb. Like a really common rule of thumb is take out 4% from your portfolio each year, and you should be fine. But it's just a rule of thumb. It doesn't work for everybody. And sometimes that's really low. Sometimes you can take out a lot more and experience some other things in life with that money and not be in danger of running out. So anyway, those are two things you got to do first. Figure out when you're going to claim Social Security, figure out how much you can spend each year and not risk running out of money. So the second step, or kind of the first thing you do after you have those preliminary steps done, is the question is how much should I withdraw? That's a really easy calculation. You just figure out, okay, what's your expenses what are your expenses? And that's what we figured out earlier, like how much can I afford to spend each year, not run out of money. And then subtract out whatever your income is already going to be paying for. So you'll have Social Security, most people will. Maybe you have a pension, maybe you have some rental income or some farm income. So if you've got, let's say you figure out, hey, I can afford to spend $120,000 a year in retirement, I should be fine. And then you're going to get $50,000 from Social Security. You don't have any other income. Well, that means you're going to need to withdraw $70,000 to make up the rest. That's pretty simple. I'm going to share with you a different screen here of an example. So this is Paul and Ellen, a fake couple here who they're going to retire in 2022. And can you see this screen, Amy? Okay, cool. Just wanted to make sure I'm not talking in a black hole here. So the Paul and Ellen have $36,000 a year they're going to get in 2024 just from a pension, so $3,000 a month. Ellen is claiming Social Security right away, or at age 66, I should say. So their total income is going to be $50,000 in the first year of retirement. Should point out that later on, Paul is also going to be claiming Social Security, but not till he's age 70. Well, then here are those expenses that we talked about. They've got $10,000 a year in travel, $11,000 of healthcare, that's like Medicare, Medicare, Medigap, maybe some out-of-pocket expenses, and then $94,000 on everything else. So a total of $116,000 of expenses. There's also some income tax that they'll have to pay. So go back to my formula earlier, you take your withdrawals or your outflows, you subtract out your income, and you come up with $71,000. That's how much Paul and Ellen are going to have to take from their different assets. Now, that doesn't necessarily mean they have to take $71,000 out of their investment portfolio. They might have CDs or money market accounts or savings accounts. Those are also fair game for withdrawals. People usually don't think about a withdrawal strategy including those things, but it really does. Spending down those cash accounts are an important part of the withdrawal strategy. So they're going to have to take $71,000 in the first year. You can see that over time, they're going to have to take a little more out of their assets each year. And then here in 2028, it drops. So they only have a $43,000 withdrawal need. Well, that's because Paul's taking Social Security then. So he flips that switch, and all of a sudden they don't have to take out nearly as much from their portfolio over time. So let's go back to PowerPoint here. And so we've established that, okay, that's how much you need to withdraw, simply your expenses minus your income. Well, where should you take it from? Well, you kind of have three options. You have pre-tax retirement accounts, of traditional IRAs, traditional 401ks, those types of things. You have post-tax retirement accounts, like Roth IRAs, Roth 401ks. And then you have what we call taxable accounts. I try to refer to them as non-retirement accounts. Those could be investment accounts that don't have any like IRA designation or retirement type designation. It's also the CDs, the money markets, and the savings accounts that I referred to earlier. So those are your options. So which one should you take it out of? Well, I think you should take it out of kind of a combination of those accounts so that you smooth out your tax bill. Why wouldn't you just take it out of all of your traditional IRA assets first, or all of your Roth IRA assets first, or all of your non-retirement accounts first? That's actually a common thing that people think they should do. It's called a spending order. Like people think, oh, you should take it out of Roth IRA first, delay that tax on the traditional, and just drain all your Roth accounts or drain all of your non-retirement accounts, and then start pulling money out of traditional IRAs. Well, here's what that might do, okay? This is a good illustration from Fidelity where they talk about a strategy where someone does just take out all that money from the non-retirement accounts first. So this is like CDs, money markets, or non-retirement investment accounts. So in these first 7 years of retirement, it looks like this family has a $35,000 withdrawal need, okay? And they do that every year for the first 7 years of retirement, all from their non-retirement accounts. So their tax bill, that's down here, they really don't owe any ordinary income tax on those withdrawals. You pay capital gains tax, but you don't pay ordinary income tax on withdrawals from those types of accounts. Then, once those accounts are totally drained, they withdraw from their traditional IRAs, their traditional 401ks. And those are taxable with ordinary income. So they've got these big tax bills from year 8 to year 18. And you can see they're actually withdrawing a little more in those years than here. Well, why is that? Well, it's because those withdrawals from the traditional accounts cause a tax bill. So if you need $35,000 and you withdraw that much, it causes a tax bill on that, and you have to withdraw more just to pay for that tax bill. That's why you can see the amount increasing there. But the bigger idea, or the bigger problem with this, is that all of your taxes are in these years, and you don't have any here because you're taken out of Roth IRAs after your traditional IRAs are all used up. And the reality is that this might be more tax than you really need to pay. You might be jumping into higher tax brackets than you would otherwise be in. You know, if you're jumping into the 32% bracket, that might be more than you would otherwise need to be in. What do I mean by that? Well, here's an alternative strategy where you're taking out some money from all these different types of accounts each year. So some from taxable, some from traditional, and some from Roth or tax-free. And there's a tax bill every year. As you can see in years 1 through 24, you're paying a little bit of tax, but maybe you stay under the 12% income tax bracket on all of those years, and you never jump into like the 32% bracket. That's what I mean by smoothing out your tax bill. So if you added up the tax bill in years 1 through 24 here, it might be less than what you paid under this scenario. So hopefully that makes sense in smoothing out your tax bill. Don't just take it all from one account or another account until it's gone, and then move on to the next account, take it out until it's gone, and then move on to the next account. I should say don't default to that. Sometimes that might actually be the best strategy, but in this example, it's not. So you need to be a little more thoughtful than that. Okay, Amy, have you been to London?
I have not been to London.
Well, have you heard the tube, their subway, mind the gap? Yeah. So they always say, my wife and I went there in 2017, and I had heard the term mind the gap before, but it's like that space in between the subway and the edge, and you make sure to mind the gap, don't trip and fall into the crack.
Exactly.
Yeah. Okay, mind the tax when you do your withdrawals, all right?
Good advice.
Be mindful of what, yeah, thank you. I should stay a financial planner though, and not try to do comedy. My wife actually did some part-time comedy years ago, some amateur comedy. She's much funnier than I am, but I am not. So let's think about minding the tax, and even minding the tax gap. What do I mean by that? Well, this graph is kind of busy. I stripped out a lot of the keys from these so it didn't even cause more confusion. But this is an example. All right, well, let me tell you what you're looking at here. So these lines are the different tax brackets. This line on the bottom is 12% tax bracket. And then this next one is 22%. And this next one is 24%. And then finally, this one is a 32% bracket. So this particular person, they are taking out money from traditional IRA assets in these first 5-6 years of retirement, but they're not taking hardly anything out of those traditional IRAs. And so they're barely in that 12% bracket. I mean, they're over the 12% bracket, but they're not even really close to this 22% bracket. Then in these few years, they're mostly in the 22% bracket, and they just creep over the 24%. And then What really changes things for this couple is the required minimum distributions start in when they hit 72. Well, you may not know this, you may know it. When you hit age 72, you have to start taking a certain amount of money out of your traditional IRAs. So this is what happens to a lot of people. Once that happens, it pushes them into a higher tax bracket. So these folks are now well into that 24% bracket. And then you can see down in this year, it's like 2053. They have some big expense and they have to take out a bunch of money that causes them to jump into that 32% bracket. So they're filling up that 24 and then even paying tax in that 32% bracket on some of that money. Well, this is a strategy that's just kind of by default. They're not being super mindful of, they're not minding the tax. They are just taking it out like of mostly non-retirement accounts and just thinking like, I don't want to pay tax on IRA withdrawals, so I'm going to take it out of this traditional or this Roth account. Well, what's an alternative strategy? This is a strategy where instead of just trying to keep tax as low as possible in those first few years, they are what we call filling up the 22% bracket, okay? So you can see here, now they're withdrawing up to this line, which again is the 24% bracket. So they're intentionally causing income tax to happen until they hit that 22% tax number, and then they're not taking out any more from their traditional IRAs. Now, later on, you can see that there is a little bit of money, a little bit of the withdrawal that's taxed at 24%, but they never even get close to this 32% bracket. Whereas here, they exceeded that 32. Here, they're far from it. Except for these last 3 years, they're kind of close. So it looks like someone passes away, so now they're subject to single taxpayer brackets. That's why you see this big dip. But the point is, this is called smoothing out your tax bill. And how does that affect your lifetime of taxes? Well, in this example, it's saving this couple $270,769 of ordinary income tax over that 25-year period, 30-year period. That's really powerful. And that's not a guarantee at all. We don't know what tax brackets are going to be like in 20 years. We don't know exactly how the portfolio is going to grow, so we can't predict RMDs. There's a lot that's unknown here, but we can take what we know and make some educated guesses on how to form a very thoughtful withdrawal strategy that's minding the tax. So that's kind of all I have on illustrations. I mean, I will say that it gets pretty complex and just kind of hard to figure out, well, okay, if I'm going to fill up that 22% bracket, how do I do that? Or how much do I need to pull then to fill up that bracket? Well, we have tools that we can use to help with that. We also rely on folks, accountants. If we ever come up with tax planning suggestions and someone works with an accountant, we're going to run those by the accountant to get their input. But there are a lot of accountants who just don't do that long-term tax planning. They're so focused on reducing this year's taxes that when you say, oh, let's accelerate income, they would question, well, why would you want to do that? But there's also a lot of really intelligent and long-term focused accountants in town who do think about those things. So we're just part of someone's financial care team, and we use the other members of people's teams like CPAs to really form a tax mindful withdrawal strategy. So
Great.
Hopefully that helps. And if you're working with us, hopefully we've already told you about some of those things. If we haven't talked to you about those things in detail, then let us know when we can.
Thanks, Dan. That's really good information, and I appreciate you sharing the slides and the content. I do want to remind everybody that you are welcome to ask any questions. We do have a few questions that a couple people have asked. So if you have additional, please type them into the Q&A or the chat, and we'll hope to get to them. First, Dan, I'm going to share a question that was one of the first to come in. It said, I keep hearing about backdoor Roth contributions. Is that something I should do?
Yeah, that's a great question. Actually, it's really timely because the Congress is thinking about getting rid of backdoor Roth contributions. So even the phrase backdoor Roth sounds like you're doing something shady. Well, the IRS kind of gave its blessing on this strategy. And I'm not going to get into details of what it is or how to do it, I should say, but it's basically a way to get money into a Roth IRA when you're over the income limits on contributing to a Roth IRA. If you are eligible to do that, and there's a lot that goes into that, but if you are eligible to do that, then yeah, I mean, oftentimes it does make sense to. There's a limit on how much you can do, but you know, this year might be the last year that people can do it. So if you typically do that, if you're a client who's watching and you typically do that, reach out to us soon because you might need to do it before the end of the year. Typically, you can wait until next April or so to do it. But
all right, we have a health insurance question that asks, I'm enrolling in health insurance right now. What is the advantage of contributing to a health savings account?
So health savings accounts, the money that you put, as long as you're eligible to get an HSA, you have to have a high deductible health plan to be eligible. But if you are eligible, then money you put in is reduces your tax bill for this current year. It grows tax-free, and whether you just have it invested in cash and you're getting a little bit of interest, which in today's environment is like pennies, but those pennies you get are tax-free, or if you have it invested within your HSA, the growth is also tax-free. And then when you take it out, it's tax-free withdrawals as long as you use it for qualified medical expenses. Or if you are over age 65, you can use that money on whatever you want and you won't pay a penalty. You do pay income tax, just like an IRA withdrawal. You could literally be 67 years old and take out $10,000 to go on a trip and use your HSA, and it would just be treated like an IRA withdrawal. There's actually ways you can avoid tax on that if you're super organized and you keep track of medical expenses, in your younger years, but that's really complicated. Most people aren't going to be able to do that, but it is possible. So anyway, yeah, tax-free contributions, tax-free withdrawals, as long as you use them on qualified expenses, and tax-free growth. It's the triple tax savings, which is not a thing on any other type of account. Like an HSA is the most tax favorable account that exists.
Great, yeah, a good thing to take advantage of.
Yeah.
And one more, you referenced this a little bit, I think, Dan, but we'll talk about year-end tax planning. The question is, what kind of year-end tax planning do you do that my accountant might not do?
It's hard to say. I mean, some folks, accountants, do like super comprehensive tax planning. And like I mentioned earlier, other accountants are just really focused on more tax filing and recording what you already did, and they're not necessarily proactive. So if you have one of those types of accountants who you really just give them all your forms at the end of the year and they file it, and they don't really give you advice, then some of the things that we do that type of accountant is not doing would be figuring out if we should do a Roth conversion, figuring out if it would be advantageous to use an HSA if someone's not already, and if they qualify, making IRA contributions if that's an option for someone. There's just harvesting tax losses, harvesting tax gains. Those are things we can do within a portfolio that the objective is to lower your long-term tax bill. Won't get into the details on that, but that's like in non-retirement accounts, we do those things. College savings account contributions are things that we think about in year end because those have to be done before December 31st. So yeah, I'm sure there's others, but we oftentimes will look at a tax return, at someone's tax return, and consider their tax return from last year, and then consider, okay, what has changed in this year, and what might someone be able to do to lower their taxes. So.
All right. Well, thank you, Dan. Thank you for joining us. We're no more questions on our end. So we appreciate you being with us today. We'll reach out to you about next month's office hours, and we hope you enjoy a beautiful fall weekend. Thanks again.
Yeah, thanks everybody.